Welcome to People and Profit, your essential business briefing. Coming up, a slowdown, showdown, Brexit and trade tensions leave European economic growth stuttering. The UK's departure is a big risk for the Irish economy, but Dublin has found a silver lining with firms moving in. And we'll check in with what's been happening in the City of London. Has the rumoured jobs Brexitist materialised? First up, though, more signs of a slowdown in global growth, and in particular in Europe. The Organisation for Economic Cooperation and Development says that uncertainty over issues like trade and Brexit are hurting business and consumer confidence. A disorderly or no-deal Brexit, the OECD says, would substantially raise costs for European economies. Already, the organisation has slashed growth forecasts for the Eurozone overall, its major economies and the United Kingdom. These figures based on a smooth Brexit, but still see the UK growing by less than 1% this year and next. I'm joined now by the OECD's chief economist, Laurence Boone. Laurence, thanks for being with us. I'd like to start by asking you about Brexit. When you look at the situation now, just weeks to go until that Brexit deadline, are you looking and profiling for a no-deal scenario or a deal scenario, or how do you see it playing out?
So for the UK, we've always assumed that there would be a deal, and that's what we continue to do. And if it was delayed by a few weeks, then it would bring about a little more uncertainty, but we still continue to include in our projection a deal.
In this report, though, you have looked at the effects that the uncertainty has already had on the UK's economy. Tell us about that.
Yeah, in this report, what we have looked at is how much the UK, how much the UK is missing in terms of GDP growth compared to the projection we had made prior to the referendum, and also compared with the real observed GDP growth of similar economies to the UK, which is the US, Germany and France. And when we do that, we see that the UK is missing between 0.7 and 1.7% of GDP since 2016 until the end of 2018. And that's a lot due to the investment, which has really stalled since the beginning of 2017.
And even since November, you've seen that picture disimprove. Is that just related to Brexit, or what other factors are at play?
So we've revised down our projection for the UK, which is now supposed to go at a little bit less than 1%. And it's due to some extent to the Brexit and the impact it has on investment, as we were mentioning. But obviously, the UK is an open economy, and it's also being dragged down by the uncertainty created by the trade tensions around the world, and to some extent, the slowdown in China, which is another one of our concerns.
What do you see happening if there isn't a deal? I know you said you're currently working on the basis there will be one, but what sort of effect would it have both on the UK and on Europe in general if there's no deal?
So back in 2016, we had looked at what would be the effect of a no-deal Brexit, and we haven't changed our assessment, which is that it would shave about 2% of GDP in the short term and probably 5% in the longer term. That being said, what I would really like to say is there's a lot of uncertainty about what it would be in the long term, because we don't know what type of trade relationship the UK will be able to deal with other countries. The other thing is it's super difficult to estimate what would happen in a transition period, how financial market would react, the equity market, interest rates, but we haven't looked at. So altogether, the only thing I would like to add is it's better for everybody if we strike a deal and if the relationship between the UK and Europe remain as close as possible.
Some of the UK's neighbours on the continent as well have some bad news in this report too. Germany and Italy stuck out for me as countries that are seeing significantly lower growth. What's happened there?
So there are a number of factors at play explaining why Germany and Italy have been revised down to a large extent, and that's really the two countries are behind the revision for the Eurozone. One is the major factor is really the trade tension, which are taking their toll on economic growth. You know, one very striking number trade growth has collapsed globally from 5.25% in 2017 down to 4% in 2018. But when we look more precisely at the Eurozone, then the export of the Eurozone to the rest of the world, their growth rate has collapsed to zero. And it's the same for the exports of goods within the Eurozone. So there's external weakness, and there is also internal weakness to the Eurozone. And that's weighing on Germany and Italy, which are two big exporters of the Eurozone.
Do central banks have any power in this situation to help the slowing Eurozone or other economies?
So two things of that. I think central banks have a lot of power. They used a lot of it, but they cannot do everything by themselves. And what we really need to see now, it's Eurozone countries taking advantage of these low rates, which are there for long, to actually do two things. For those with low debt to GDP ratio, they really need to invest in their public infrastructure. So that's 5G, broadband, school, roads, and all these type of things. And for all of the Eurozone countries, where GDP growth per head is at 1% or around that, then there's a urgent need to actually elevate this trend growth by reviving business dynamics, taking measures to actually include better everybody into the workforce and put people in job. Because with 1% per head growth, we are not elevating living standards for all. So in one word, yes, it's time for fiscal and structural policies to take the relay of monetary policy.
OK, Laurence Boone, Chief Economist from the OECD, thank you for speaking to us. Well, now the Irish economy is one of those set to be worst hit by Brexit, particularly if the UK leaves without a deal. But Dublin has at the same time been attracting increased investment since the vote, with many financial firms choosing to open offices or expand their operations there. Catherine Viette has more.
The skyline may be less imposing than London's, but as Britain prepares to leave the European Union, financial firms are looking to Dublin as a potential new base to retain access to the EU's single market.
Increasingly, and especially in the last 2 to 3 months and post-Christmas, one has seen an increase in the number of people coming to Dublin. Places have opened, institutions have opened that weren't previously here, or they've expanded the number of people they've got in Dublin.
According to consulting firm EY, Dublin is leading the race to win so-called Brexitist business, with 27 financial companies committing to relocating staff or operations there. English-speaking, with low corporate tax and just an hour's flight from London, the Irish capital is an attractive prospect for many. This law firm's newly opened Dublin office has been seeing an uptick in Brexit business.
In financial services, we're seeing a little bit more work in terms of clients undertaking kind of bigger projects about, remuneration or immigration, particularly in those areas where you see that the higher paid, more senior executives, maybe moving to Ireland.
Ireland's government has been unafraid to pitch Dublin's rise as a rare upside to Brexit.
The point that I've always made is that if there are companies in the UK who have a Brexit difficulty, well, Ireland can be part of their Brexit solution.
But any silver lining for Ireland could be wiped out if the UK leaves the EU without a deal. Ireland's finance minister says a hard Brexit could cost over 50,000 Irish jobs and slice 4% off the country's GDP over the next 4 years.
After the Brexit referendum in 2016, there were warnings that tens of thousands of financial industry jobs could be lost in London. With now weeks to go until the UK is set to leave, it seems that the final number of jobs affected will be much lower. As in many quarters of the country, opinions about Brexit in London's financial centre remain divided.
I think that Europe's holding us back. I think that I think the relationships are deteriorating. I think we've got greater opportunity outside the Eurozone at the moment, principally the Far East and the US.
I think it will be an absolute disaster. I'm terrified. It's the single biggest fear I have is Brexit happening.
Some trepidation. I think it's not clear quite where we're going to end up, but overall, I think we'll be okay.
Predictions of an exodus from the city have, for the moment, fallen far short. Kate Moody's been looking at what has actually changed in London. Kate.
Stephen, the latest survey by Reuters shows that only 2,000 jobs have been moved or created elsewhere in the EU as a result of Brexit. EY's Brexit tracker forecasts that 7,000 will be impacted in the near future, and the UK government puts the number closer to 5,000. More than a third of financial services firms say they are still planning some sort of relocation. Now, to break it down, HSBC is transferring a fifth of its 5,000 UK-based jobs. Goldman Sachs has committed to 700 and Deutsche Bank 500. JP Morgan, which had made the most drastic predictions, has only moved 400 of its 16,000 British jobs. For now, EY says that Dublin has attracted the largest number of firms, followed by Paris, Frankfurt and Luxembourg. Now, there are other signs of uncertainty. Recruitment in London's financial sector hit a 6-year low in 2018, down a third from the previous year. Money is flowing away. Some €927 billion in assets have been moved out of London. Firms are also reportedly offering financial incentives to employees who agree to work outside of the UK, even on a temporary basis. Now, the city's future is largely dependent on reaching an equivalence deal with the EU. That's essentially agreeing that another country's rules provide the same level of oversight and structure, but it requires approval on a sector-by-sector basis. A no-deal Brexit would see UK-based firms effectively blocked from doing business with clients or companies in the EU. The UK and US have already agreed terms to limit disruption to the $500 trillion derivatives trading industry, but that's just one piece of the Brexit puzzle. Stephen?
Kate, thank you very much for that. Well, that's it from us for now, but you can, as always, find the best of our business coverage on our Facebook page, France 24 Business, and you can find me on Twitter @NewStephen. Until next time, thanks for watching.